So if you were watching D-Wave Quantum, that's ticker QBTS, on a recent trading day, you might have felt that pit in your stomach.
Oh, yeah.
The stock closed down over 8% in just one session. I mean, for a lot of people, a chart that just screams, get out now.
It looks like pure panic, market doubt.
Exactly. But the financial analysis report we're looking at today sees that exact red day, that volatility, through a completely different lens.
The very different lens.
This isn't your average analyst note. It's an intensely bullish take that frames this dip not as a reason to run, but as a critical, maybe even time-sensitive buying opportunity.
And that's really our mission today, isn't it? To unpack this incredibly aggressive thesis. I mean, the report is claiming over 90% upside ahead for QBTS.
90%.
Yeah, they're projecting a move to $48. That would nearly double the recent price.
Yeah.
So we have to dig into the arguments they're using to back up a claim that big. We're going to break down the three core pillars of this whole narrative. The technology, which they're calling the Advantage 2 supercycle, then the balance sheet, and finally, the technical setup on the chart.
And this deep dive is really for you, the person who wants to understand why on earth an analysis report is comparing this company, D-Wave, to the NVIDIA of 2026.
It's a massive analogy to make.
It's a huge one, and we need to see how they justify it. Okay, so let's unpack this context first.
Well, what's interesting is that the report doesn't shy away from the volatility. It leans right into it.
Acknowledges it head on.
Absolutely. Talks about that steep pullback, that 8% drop. Specifically, it mentions the stock testing its recent lows, bouncing just a little bit off of 24.76.
So that price level is important.
Very important. The analysis sees it as a key line of defense, a support level.
And this is where the report sets up what it calls the contrarian framing. It paints this picture of two different types of investors reacting to that drop.
Exactly. On one side, you have what they call the retail crowd. They see the red day, they get scared, and they panic sell, right? Often locking in their losses right there at the bottom.
We've all seen it happen.
Right. But then the report argues that this is precisely the moment where, quote, the smart money operates differently.
Okay.
They see the dip as, fundamentally disconnected from the company's actual long-term value. So they use the volatility to strategically buy in. It's that classic move of absorbing shares from the fearful sellers at a bargain price.
So that raises the big question, right? Why does the analysis claim the risk-to-reward ratio is so good right now?
It all comes back to that support level. The whole premise is that the downside risk is pretty limited, right around that mid-20s price range.
So if it holds there.
If it holds, the potential upside, based on that $48 analyst target, is almost 90%. They're basically arguing that for a company with truly disruptive tech, that kind of setup is undeniable. That is, if the fundamentals are solid.
Which brings us right to the first pillar, the big one. What the analysis calls the Advantage 2 supercycle. The narrative here is that quantum computing it's finally moving past theory. It's not just a lab experiment anymore. It's stepping into commercial reality.
And the Advantage 2 system is the specific thing, the catalyst that's driving that shift. For so long, the question was always when quantum would be useful. This report is saying the answer is now.
And what's so special about their technology? The report really highlights D-Wave's core advantage being that they're the only player selling both annealing and gate model solutions. For anyone listening who isn't, deep in the quantum jargon, why is that dual approach such a big deal?
It's a huge deal because it gives them two shots on goal. The simplest way to put it is that annealing quantum computing is really, really good for optimization problems.
Like logistics.
Yes, exactly. Finding the best route for 1,000 delivery trucks, financial modeling, discovering new materials, that kind of thing. Gate model, on the other hand, is the more general purpose approach. It's closer to how your laptop works. And that's what most people think is the future for, say, complex AI.
So by offering both,
they can solve a much wider range of real-world problems today instead of just waiting for one perfect universal quantum computer to be invented.
So they're actually making money now with the tools they have.
Yes. The analysis gives real examples. They cite trials where the Advantage 2 system took a complex logistics problem like optimizing delivery routes and cut the computation time from hours down to just a few minutes.
Wow.
That's the kind of efficiency that companies will pay a lot of money for. That's high margin revenue.
And that ties directly into the growth curve they're projecting.
Right. If you look at the numbers the report cites, they're forecasting revenue to really ramp up. It's moving from about $24 million in the last 12 months to a projected $39.5 million next year.
So that's the start of that steep part of the curve.
That's what they're betting on. It's that classic hockey stick growth you see when a company finally starts to commercialize something truly disruptive.
But hold on a second. The analysis calls this a massive strength, this dual approach. But isn't there a counterpoint? I mean, is developing two fundamentally different quantum systems a huge strain on R&D?
That's a really fair question. And the analysis sort of addresses it implicitly.
How so?
They frame it not as a strain, but as a strategy. It's risk mitigation. By having the annealer, which is more mature, they're generating revenue right now.
Okay, so the current tech funds the future tech.
Precisely. The money they make today secures their path for tomorrow, which actually brings us perfectly to the second major point in the analysis, what they call the cash fortress.
Right, because growth forecasts don't mean a thing if you run out of money.
Especially in a field this expensive.
The report says the #1 killer of these kinds of growth stocks is dilution. They run out of cash and have to issue tons of new shares, crushing the stock price.
And this analysis is emphatic that QBTS has solved that problem, at least for the foreseeable future. They've built a massive financial safety net.
And the specific number they cite is huge.
It is. They detail that the company is sitting on roughly $836 million in cash.
$836 million. Just to put that into context for you, we just said their annual revenue right now is around $24 million.
So that cash position is enormous relative to their current operations. The report is very clear. This is enough to fund years of R&D and operations without having to go back to the markets for more money anytime soon.
And that's why they call it the cash fortress.
Exactly. It gives them the runway to execute their Advantage 2 strategy without the constant threat of dilution hanging over them. The report even uses the word bulletproof to describe their balance sheet compared to some competitors.
So that's what's keeping the stock at $25 and not, say, $5.
It's that security. The market sees that they've bought themselves time.
Okay, so we've got the tech that's generating revenue and the cash to fund the plan. So let's get to the target. Why $48? Why that specific number?
It really hinges on this idea of a huge structural shift in the whole computing market, and it's all being driven by AI.
Okay.
The logic in the record is that traditional hardware, the GPUs that have powered this AI revolution so far, they're starting to hit a wall.
A compute wall.
Yeah. The AI models are just getting too big, too complex. They're outgrowing the ability of classical computers to scale efficiently.
So quantum stops being a nice-to-have and becomes a need-to-have for certain problems.
You've got it. It's being positioned as the necessary next step. And that leads right into that really ambitious comparison they make.
The NVIDIA of 2026.
The NVIDIA of 2026.
That's such a headline-grabbing claim. I mean, how do they even begin to justify comparing a quantum company to NVIDIA?
They justify it by drawing an analogy between the market inflection points. They argue that back in the day, NVIDIA went from being a niche company for gamers to being the absolute foundation of a trillion-dollar industry.
Right.
The analysis says D-Wave's at a similar point right now. If their commercialization works, if they hit that revenue ramp, and if the market accepts quantum as the way forward for these massive problems,
then they capture that foundational market share.
They capture a huge piece of it. The report argues that if they hit their revenue forecasts, then a $48 price tag isn't crazy. It's just a realistic 2x move for a company in this kind of explosive sector. It reflects where NVIDIA was right before its own breakout.
That does make the narrative much clearer. But if the fundamentals are so strong, why the big dip? Why the 8% drop? Which brings us to the technicals.
Right. The report uses the technical setup to explain the immediate opportunity. They see the recent price action as a textbook setup for a powerful reversal.
So what are the key levels they're watching?
The big one is support, right around $25. They call it the critical line in the sand.
And the bounce we saw confirms that.
In their eyes, yes. It confirmed that buyers are stepping in to defend that price. And then looking up, the next major hurdle is resistance at $30.
A psychological barrier.
A huge psychological and historical barrier. But the report notes that once the stock breaks cleanly above 30, there's, and I'm quoting here, very little friction until you get to $40.
Meaning the move could be fast.
Very fast. It could accelerate quickly once 30 is cleared.
So the whole buy the dip idea is based on this pattern.
It's a classic technical rationale. You have this massive rally, right, from $3 all the way up to 47. Then you have this pullback to 25. The analysis calls it a classic 50% retracement from the highs.
A common spot for a bounce.
A very common spot where strong buyers tend to re-enter a stock. And they also point to a couple of cooling factors.
Like
specifically the RSI, the Relative Strength Index. It's a momentum indicator. The report says it has cooled off, which means the selling pressure is likely exhausted.
So the weak hands are out.
That's the phrase they use. The weak hands are out. The less committed investors have sold, leaving the field clear for buyers with higher conviction and, for the algorithms that are programmed to buy at exactly this $25 support level.
Okay, so to quickly recap the three pillars of this whole bull case.
Let's do it.
First, according to this analysis, QBTS has the commercialized tech, that Advantage 2 system solving real problems today. Second, they have the deep cash reserve, over $800 million protecting them from dilution.
The fortress.
And third, they have the strong analyst backing and a technical chart setup that's pointing toward that massive $48 target.
And that's why the report concludes that the current price presents an undeniable risk-reward opportunity. They're betting the fundamentals are so strong that the downside from here is small compared to the potential for the stock to nearly double.
It is a powerful thesis. But it leaves us with one final provocative thought for you to think about. If the technology really is solving problems today, and that huge cash pile secures their future for years, how much of that ambitious NVIDIA of 2026 valuation is already priced in at $25? And maybe more importantly, which specific application is going to be the key driver? Will it be the logistics optimization problems, or will it be the more advanced AI training that actually generates the revenue needed to blast the stock past that $30 resistance barrier? That's the signal you'll want to watch for.